All right, since we just hit 12 o'clock on the dot, we can get started. My name is Rachel McKinley. I'm the Vice President of Marketing for Maine Family Federal Credit Union, and today we are talking about teaching kids about money. Since it's Credit Union Youth Month, we wanted to help parents or caregivers figure out easier ways to incorporate financial education into everyday life, because kids aren't learning this stuff in school necessarily. We think it's really important to make sure that children are learning from a young age all the way through how to manage their money, because it's such an important skill. So today's agenda, we're going to talk a whole bunch of different topics, because it's no children's age is too young or too old to talk about money. So providing kids with age-appropriate concepts will make them better prepared to handle your tough financial decisions throughout their lives. So first, we're going to start to talk about opportunity cost, earning money, savings, checking accounts, budgeting, and credit, before we wrap up with some tips to help you successfully teach kids about money. I'll reserve some time at the end for questions, but we'll also stop between each section. So if you have questions, just add those into the Q&A or the chat, and we can answer those as we go through. So the first thing we wanted to start was talking about opportunity cost, because it's a fundamental part of teaching money concepts. Opportunity cost is foundational because it underpins every financial decision that we make, from daily purchases to long-term savings goals. The good news is that even young kids can grasp this concept when it's presented in terms that they understand, like choosing between 2 toys or 2 treats. So as we move through this section, we'll walk through age-appropriate examples that you can adapt for the children in your life, starting with simple scenarios for younger kids and then building up to a little bit more complex opportunity cost trade-offs for teens. So before diving into those examples, just take a minute to think about how you would explain opportunity costs in terms that they can relate to. So the key really is meeting them where they are, because a 5-year-old and a 15-year-old are going to need very different explanations. For younger kids, it's easier to keep it concrete and visual. So like candy, toys, stickers, whatever motivates them, those are good objects to use to help them understand the opportunity cost. For older kids and teens, you can introduce something that's a little bit more abstract, like time versus money, or short-term fun versus long-term goals. So the good news is you don't need a finance degree to teach any of this. At its core, opportunity cost is simply, if I choose this, what am I giving up? So we'll walk through some specific examples for different age groups on the next few slides. Then you can use those as a starting point and adapt them to your child's specific needs. So the concept of opportunity cost is basically that spending money now will leave you with less money to buy items in the future. So what do you have to give up in the future? That opportunity cost is the regret that you anticipate from not taking another option. So a simple analogy is, imagine you're at lunch and you can either buy a sandwich or a salad, but not both. So choosing the sandwich means giving up the salad. That missed salad is your opportunity cost. And that concept extends well beyond money. It also applies to how we spend our time and energy. Another example is an hour spent watching television is an hour not spent reading or playing outside. So explaining opportunity costs to kids, just keep it simple. You know, if you spend an hour on TikTok, you're not going to have that hour to go out and practice driving. So for a kid who is at that age, those are good examples to use to really demonstrate how that choice impacts what they're going to do in the future. It's really important to use those concrete items that they care about and avoid using abstract language. So a good starting point is to say something like, if you spend your allowance on this toy today, you won't have enough to buy that game you wanted next week. Which one matters more to you? So you'll want to determine the best way to explain this concept based on the age of your children and their maturity level. What might work for one child may not matter to another. So think about what matters to them and what they might regret losing based on their own choices. For kids under 7, just keep it very concrete and immediate. Use items they can see and touch, such as choosing between 2 snacks or 2 small toys. At this age, that trade-off should be happening right now because they're not looking future. They're thinking like what's happening right now. From children from ages 7 to 12, you can introduce a little bit of short-term planning. They can understand that saving this week means being able to afford something bigger next week. So use examples based on things they genuinely care about, whether that's video game, art supplies, sports items, whatever matters most to them. For teenagers, you want to bring in longer time horizons and more nuanced trade-offs, such as spending versus saving for a larger goal like a phone or concert tickets. Regardless of age, use items the child actually values, not what you think they should value. And just remember, it should be a two-way conversation and not a lecture. So ask open-ended questions like, what would you have to give up if you chose this? And let them go through the reasoning on their own. So for example, for young children, we have 2 different treats that they could possibly choose from. So you have gummy bears. They may like both of these. You have gummy bears or you have chocolate. If you choose the gummy bears, you can't have the chocolate. So this is a concrete way to explain what the opportunity cost is for younger children. It's something tangible. It's something that they know they can do. They know they can choose, but they can't have both. So they can be motivated, like, younger children can be motivated by smaller things. Just you can also assign it values, like give it a smaller amount of money. So they could have their, for the first item, it can be worth a lower amount. And then the second item, which is probably their favorite candy, assign that a higher value. So let them know you're going to give them $1 in coins. And this is also a good way to help recognition of different coins. And then make sure that dollar is made up of all different coins, so pennies, nickels, dimes, and quarters. Give the less desirable gummy bears 45 cents as the value, and then 95 cents for that chocolate. So explain to them, explain to them they can get less desirable piece, they can get 2 of the less desirable pieces and then still have some left over for one of their favorites. And that's just showing the opportunity cost is getting only 1 piece of candy instead of 2. So they'd be giving up that 2 pieces just to have one of their favorite. For older kids, the concept is essentially the same, other than they'll probably be motivated by things that are far more expensive. So in this example, a teenager might want a new pair of sneakers, but they also want tickets to a concert next month. So walk them through the trade-off. If they buy the sneakers now, they may not have enough for the concert, and which one of those things is going to matter to them more in the long run? Sorry. Teens can also relate to the trade-offs involving their time and not just money. So a part-time job provides income, but it takes away hours that could be spent on homework, sports, time with friends, video games. Encourage them to think about what they're gaining and giving up with each choice. Older kids are ready for more nuanced discussions about value, so you can introduce ideas like the difference between price and value, or how a cheaper item that breaks quickly may cost more in the long run than a higher quality alternative. The goal is really to help them develop a habit of pausing before they spend their money and ask themselves whether this purchase is truly worth what they're giving up. So that covers opportunity costs. Are there any questions before we move on?
There are no questions at this time.
Perfect. All right, we'll keep going. Since we've already touched a little bit on earning money, we'll continue with that. Understanding the connection between work and income is one of the most critical lessons you can teach a child, because it builds responsibility and helps them see money as something that is earned and not simply given. So discuss with your kids how you earn money and then the choices that you're making with your money. Talking about money may be difficult for you to have with your children and have them understand it. So really just make sure you keep it at their level and ensure you have the time and are in a good mental state to have that conversation. If you're tense, it may create negative associations with money for your children. So just make sure that if you're having this conversation, you're calm and you're not stressed and you have time to really answer some of the questions that they're invariably going to bring up, because kids love to ask questions. So when kids understand that money comes from effort, they tend to be more thoughtful about how they spend it. In the slides ahead, we'll look at some age-specific strategies for introducing the concept of earning, starting with simple chores for younger kids to part-time work opportunities for teens. This can start the foundation to encourage your child to earn money, as it'll promote independence and it begins to teach them the importance of financial skills. Then it could be chores around the house or a job outside, depending on their age. So helping kids to understand where the money comes from to pay your household expenses is really important. Explain how your household earns money, and then how you make decisions on how that money will be spent. Let them know there's always going to be limits on what's available. We don't have an endless supply of money to make purchases. So when having this conversation, just be mindful about what's age appropriate. For younger kids, you don't necessarily need to share specific salary numbers. You might want to say something like, the grown-ups in our family work so we can pay for our house, food, and then the fun things that we like to do together. This language works for all family structures, whether kids are raised by parents, grandparents, foster families, or other guardians, just keeping it a little bit easier for everyone to understand. For older kids, you can go into more detail about budgeting. Consider using just a simple visual aid like a pie chart or a drawing that shows how the household budget is divided amongst necessities like housing, food, and utilities, and then show how like that smaller slice for savings and fun is, and how those bigger pieces really make up the most of your budget. Having the pie chart or something visual makes it more tangible and easier to grasp. And also you want to make sure that when you're having this conversation to frame it positively, to keep positive feelings with money and not encourage stress and anxiety around money, because the goal is really not to make kids anxious, but to help them understand that as families, we make thoughtful choices about how to use our resources. Emphasize that budgeting is a tool that helps our family do something they enjoy rather than presenting it as a source of stress or limitations on what we can do. So first thing you want to do is really review with children what a need is. There's certain obligations that we have that are non-negotiable and need to be paid first with our available income. So you can get a calculator, show them how you cover your needs before anything else. So you'll take your amount of income available and then subtract your needs, which obviously are going to be housing, possibly car payments, insurance, whether it's car insurance, home insurance, health insurance, your utilities, food, and savings. And explain to them why you've determined these things to be needs. And those needs will vary with every family. Not everybody has the same expenses, so really tailor it to your own experience. So next, discuss your wants. Wants will also be different for every family, so really make sure that you have things tailored to your own situation. For instance, clothing and shoes are probably a need, but we don't necessarily need brand name clothing or shoes, or we don't need 4 pairs of sneakers. Just showing that difference between a want and a need is really, really important. And if you can tie it to real life experience, it makes it so much easier for them to understand. So you can take them grocery shopping. This is a really, really good way to show the difference between wants and needs and how your budget can impact those wants and needs. So if you take your kids to the grocery store for your weekly grocery trip, have your list, like if you make a list before you get to the store, and then your budget, so your total amount you plan to spend. As you're shopping together, use your phone calculator to keep a running total of what you're spending. And then if your child asks for extras, set those items aside. So once everything on your list is in the cart, add that all up and see what's left in the budget. So let your children know that you've covered your needs first. And then if there's a small amount remaining for a want, let them decide which one's the priority and whether it fits into that remaining budget. It's a really good hands-on way to help kids understand budget limitations and then the difference between needs and wants. So now's the time to give your children freedom to make their own choices and with the money that they have, and then learn from those outcomes. It's a critical step in building financial independence. It's, as a parent, it's hard. You don't want your child to fail, but in this case, when you make these opportunities for failure smaller, the risk is a little bit less. So just resist that urge to correct every spending decision that they're making. Instead, just guide them with thoughtful questions like, what do you think will happen if you spend all of your money on that? The goal is really to just create a safe environment where mistakes are affordable now versus costly mistakes later on in life that are harder to recover from. This remember that a child who spends all their allowance on something now is going to regret that, and they'll probably learn more from that experience than they will from any lecture that we can give them. For younger kids, assign some age-appropriate chores that they can earn money from, such as picking up their toys, helping set the table, feeding the pets. Keep the amount small, and then the connection between work and payment immediate. So pay them as soon as their chore has been completed so they have that direct link between effort and reward. Continue reinforcing those concepts of opportunity costs and wants versus needs each time they earn their money and spend their money. That helps build a strong foundation for understanding that money is earned through effort and isn't simply just given to you. To make the process of managing money fun and hands-on, you can start by finding 3 small containers, such as just empty jars or decorated boxes, and let your child personalize and label them. So label them needs, wants, and savings, or they could be save, spend, share. Have them think about the purpose of each container and set a small goal for each one. Keep those goals achievable so they don't get frustrated by waiting too long. So if they're earning $1 a week, saying they want to save $100, that's a really big goal. Maybe start with $5 or $10. Every time they earn money, sit down together and discuss which container that money should go in and why it should go in there. Encourage them to divide it across all 3 containers. This visual is like a visual tactile approach, and it helps younger kids understand the budgeting concepts that might otherwise feel abstract. Having something physical that they can touch and they can see the money as it starts to increase is a lot easier for them to visualize and understand. For preteens and early teenagers, help them determine when they're responsible enough and ready to earn their own money. So they could be doing odd jobs around the neighborhood by babysitting, mowing lawn, or dog walking, or whatever is appropriate at their age. They may be wanting to earn more money than they get from doing chores, and they'll have bigger needs and wants. It's still important to help them determine how to utilize that money that they earn to reach their financial goals. So if you haven't already, you probably want to be sure they have a savings account established, which is something we'll talk about. For kids over 15, you can discuss getting a part-time job on the weekends or after school or during school vacations. You will want to set some ground rules on the expectations for that money that they're going to earn and what they're going to use it for. This is an excellent opportunity to have them start thinking about more long-term goals like paying for college, saving for a car, or even saving for retirement, because it's never too early to start talking about that. Saving money is one of the most important financial lessons you can teach a child. It builds that foundation for long-term wealth and financial security. Children who learn how to save early can develop patience, discipline, and a sense of control over their financial future. So in this section, we'll walk through age-appropriate strategies for teaching savings, starting with piggy banks for younger children, and then savings accounts and compound interest for teenagers. The key message is to reinforce that saving is not about deprivation. It's about making your future self's life easier and more enjoyable. I'll just pause here before we move on and see if there are any questions.
There are no questions at this time.
All right, we will keep moving. So for savings, again, you're going to want to determine some ground rules for any income that your child earns. How much will you put into your savings, and then how much can be used right away? So starting early to create that habit of savings will provide a foundation for a long-term savings success. So you may have heard like the 50-30-20 strategy, where you spend 50% of your income on needs, 30% on wants, and then 20% on savings. Depending on the situation, it may not be realistic with littler kids, but as they get older, it's something that you can start to instill. The most important part is always put something aside for savings. So if the money comes from payroll, ideally the funds should be automated and go into a savings account. But if it's birthday money or holiday money, this is a really good opportunity to show them the importance of setting money aside for savings and then using some of that other money for something that they want. So for younger kids, it's easier to start. It might be easier to start with a piggy bank or a clear jar. That way they can see the benefits. They can have, savings accounts. We can open savings accounts for children as young as newborns, but sometimes it's easier to keep some of that money at home so they can actually see the amount they have grow over time. Yeah, the younger kids are more visual and more tactile, so it's sometimes easier to have all of that in front of them where they can see it on a daily basis. So just make sure that when you're doing that, just set the goals to be small so they're not waiting too long to reach that goal. They don't have that forward thinking mentality, so they're not going to think about like having to earn $100 for something that's really big. Instead, make it like really break it down into smaller goals. As your child gets older, you can bring them here to the credit union and help them open a savings account. Talk about the goals for that money that they're going to be putting in the account and start having conversations about having short-term goals. So something that will be accomplished in less than a year. So maybe buying a new game for their game console. And then also talk about longer-term goals, like saving to go to college or saving for a big purchase, maybe a car or a school trip or something like that, something that they really want. Help them start building the habit of saving for longer-term goals. And you might want to create a visual tool so that you can, your child can see the fruits of their labor. Maybe having a chart that you can color in every time you make a deposit so they can see their savings growing over time, and it helps them really feel like they're accomplishing something. So for teenagers, once they already have their savings account and they're setting money aside for both short and long-term goals, this is a good time to start discussing compounding interest. We all know if we started saving at 18, we'd probably be pretty comfortable for retirement just because of, compounding interest over time. It may seem small, but compound interest can provide significant earnings over time, and it's important to really get kids to understand how that happens. So for an example, your child gets a $200 gift and puts it in their savings account. Then they start adding $50 a month from their part-time job, and it earns 4% interest. With a 4% rate of return, that initial $200 gift plus $50 monthly contributions will grow to be over $3,500 in 5 years. So that just shows the power of compound interest at work. Walk through the calculation with your teenagers so they can see how their money grows, not just from what they deposit, but also from the interest earning earning interest over this time. A lot of times it's a light bulb moment for kids. They can see how it's going to grow just by making that small starting investment and then slowly adding pieces over time. If you show them, you could also use calculators. We have calculators on our website, which I'll link in our follow-up email. And you can show like how your money will grow if you start saving at the age of 18 versus 25. And there's a big difference in those numbers. And sometimes it's really startling to see the change after, of just like a 6 or 7 year difference. So that's a really good way, using these calculators, helping them to see on the screen how that actually makes a big difference. So now that your child has a solid understanding of opportunity cost, goal setting, and savings, the next step for teens would be opening a checking account. So a checking account introduces your child to the banking system and teaches them how to manage the money they plan to spend in the near term. It's an important milestone because it gives them real world experience with financial tools that they're going to be using for the rest of their lives. It also sets the stage for receiving direct deposits when they start working. So before I move on to checking accounts, I'll just check in again if there are any questions.
There are no questions at this time.
Perfect, thank you. We will keep moving. So in most cases, you'll need to have an adult, and this is true for us. You'll need to have an adult listed on the checking account when the child is under the age of 18. It's actually a benefit because it allows you to monitor and then guide them through any questions they have on that account. So having a checking account set up before your child starts their first official job is really important, since a lot of employers now want you to have paychecks direct deposited electronically. Ideally, what you'd like them to do is split their direct deposit between checking and savings. You've already been working hard to build that positive financial habit, so don't stop now. They can either do that by setting up their initial direct deposit to go between 2 different accounts, which is the best way to do it because you don't see it hitting your checking account and there's no temptation to spend it. Or you can also set up a recurring transfer every time they get paid to have a portion of that paycheck to go into their savings account. It's better to automate it just because it's so easy to see that money and say, oh, well, I'll just use a little bit of it this week. And then that keeps happening and the amount that's being put into savings dwindles. So we don't want to see that happen. We also want to take a little bit of time with kids to explain the difference between a checking account and a savings account. So really just letting them know that the checking account is for money you plan to spend in the short term, and then you cannot access it as often as you need with a debit card or ATM withdrawals. And then your savings account is where the money that you're going to keep your money that stays there until that specific goal is reached. So before coming to open a checking account, you want to just make sure you have all of your documents to avoid making multiple trips. So usually you will need your government issued photo ID or a driver's license for the adult, or if you're already a member, it'll be a little bit less. But for the child, you probably will want to have either a student ID or a birth certificate or a driver's license if they have one. You will need your Social Security or tax identification number, and then proof of residence such as a utility bill or a lease if your current address doesn't match what is on your photo ID. And I think it's really important, if you can, to bring your child to the credit union to open that account. It gives them a little bit more investment in the process when they can sit here and go through the process, and it just gets them more comfortable to be working with the financial institutions as they get older. So many financial institutions offer accounts specifically designed for minors, which we have here. We have what are called adolescence accounts. They're made for kids age 13 to 18. There are no minimum balance requirements. There are no monthly maintenance fees. Anybody 13 and older can get a debit card so they can access their money as they're, as they need, as they're out doing different things, especially as they're starting to drive to pay for gas and food and all those other things. The nice thing about our accounts is that we have a lot of family education along with those accounts. So on our website, we have resources for parents and for kids to help everybody understand the importance of managing money responsibly. So again, we talk a little bit about the debit card, and then just explain how we can explain how your debit card works, how you have a 4-digit PIN to authorize your transactions. Once you complete your transaction, the money comes from your account, or a hold is placed on the money until that process is complete. Make sure that we talk about using security for our PIN, making sure it's not something that can be easily guessed and they don't want to write it down. They want to make sure that they're keeping it very secure so that it's harder for people to access their debit card. It's also very important to talk with your child about not sharing their debit card or their PIN with anyone else. If they give that information to someone, they can end up with fraud on their account or having somebody else using their money, which we don't want. So make sure they're keeping it to themselves. Having a checking account is a big responsibility and really does need to be managed carefully. Explain that if they attempt a transaction for more than what they have available in their amount in their account, it will either be declined or it will bring their checking account balance into the negative and they may have to pay a fee. It's also important to have them monitor their account balance and not spend more than money than they have. Really show them how to use online or mobile banking so they can keep regular tabs on their account, and then even reviewing monthly statements to make sure that nothing unexpected has come out. Those are a great teaching tool because it's really important to know how to read those statements and then understand what all of those different transactions mean. So now that we've discussed checking accounts, we'll move on to budgeting, but I'll pause for a second to see if there are any questions.
We do actually have a question.
Okay.
So as a parent, what account or accounts do you suggest starting for your child while they're young to assist with their first car, college, anything along those lines, like savings bonds, CDs, high yield savings account?
That is a great question. I would say it depends on the amount that you're starting with and what your goal is. Any of those are appropriate. I think just starting with a basic savings account is a good way to start. If they're not planning on touching that money, opening a certificate of deposit is a great way to earn a higher interest rate on the money that is not going to be touched for a while, especially if you're looking to save money for a longer term goal like a car or college. Higher yield savings accounts are great if you can get that, and then it depends on the balance. Sometimes there's minimum balance requirements that can impact how what you're saving for. But I think at the base, having a regular savings share account is one of the most important things that you can do for a child because it just sets them up for success over time, because you can just take the money that they're earning from gifts or chores or jobs, and it just starts to add up and sets them on a good financial path as they start growing. Hopefully that answers the question. So now we get to
the question.
We'll move on to budgeting, which is always a fun topic. Helping kids learn how to budget and create a plan for their money is one of the most valuable things that you can pass on. Budgeting isn't just a list of numbers, it's really a roadmap for reaching your short and long-term goals. Research actually shows that people who budget regularly are significantly more likely to feel in control of their finances and less likely to carry excessive debt. So by teaching that budgeting early, you're giving your child a tool to use for the rest of their lives and set them up for success. So in this section, we'll walk through how to create a budget step by step. So the first thing is really to help your child understand that a budget is really a planning tool that ensures their money is covering all of their priorities, so all of those needs, and then helping them work towards their goals. Like anything important in life, it requires time and attention that you need to dedicate to this. So it's, if you can, to set aside some regular time each month to all sit down and then review the budget. It could be the first weekend of the month or whenever they receive their allowance or their paycheck. Making it a habit takes the stress out of the process and turns it into a normal part of managing your money. So treat it like a checkup rather than a chore. Okay. you may want to consider sharing your own budget with them or work to create your own household budget while they're working on their personal budget. It's really important to not judge their budget choices. Instead, just ask questions and kind of get a feel for why they're making the choices that they did. Even if you don't agree, you may want to consider letting them continue, because learning by experience is one of those best teaching tools. It's better to help them learn that all of their choices come with consequences. It's a lot easier to learn when the stakes are much lower than they are when they're adults and they're making choices that may set them back for years at a time. So just remember that the candy example that we used during the opportunity cost section, or the shoes and the concert tickets, reinforcing the importance of making smart choices now will hopefully help them avoid making mistakes when things are more risky as they get older. Before you sit down and make your budget, just make sure your child has everything they need, which includes a record of their income, whether it's an allowance log, receipts from odd jobs, or pay stubs from a part-time job. They should also have their bank statements accessible through online banking, a list of any expenses that they're responsible for, so maybe car insurance or gaming subscriptions or whatever the case may be, and have them write down their savings goals. Having that in writing is also helpful to stay on track. And having all of that information in front of you makes the budgeting process much more productive. It's just much more smooth. And then it teaches them the importance of keeping organized financial records, which will be a good habit to serve them well into adulthood. After this session, we will follow up with an email with the recording, but also we'll have a link to a budget worksheet on our website that you can download, and you can either fill in online, or you can print it and have a physical copy to help your child build a budget. So walk through each of the categories with your child as they gather their documents. So you want to start with your income and then pull up their bank statements or their online banking to look at their recent transaction history. So then that helps you determine which expenses they're responsible for and whether they have the capability to take on any new ones. Review how much they've been able to save and whether they're on track to meet their savings goals. And for some families, if generosity is something that you want to instill, this is a good opportunity to introduce the concept of giving, and setting aside a small amount for a cause they care about can help them learn empathy and social responsibility, while also reinforcing that money is a tool for making a positive impact. So you want to make sure their budget balances, and if it doesn't, help them figure out what changes they need to make to balance that budget, and then stress the importance of not spending more than you're making. You need to make sure that budget is balanced. Once their budget is in place, the next critical step is to track spending against the plan. So the budget's only useful if you know whether it's being followed. Help your child choose a tracking method that works for them. It could be a spreadsheet. Google Sheets has some great templates available for free. They can use pen and paper with the sheet that we're going to send you after this session. You can use online banking tools or budgeting apps that are designed for younger users. The key, no matter which method you choose, the key is to be consistent with it. Just encourage them to log their spending daily or weekly, rather than trying to do it at the end of a month when they can't remember what they've spent. When they see their money actually going somewhere versus where they planned it to go, it helps create one of those powerful learning moments and helps them adjust their habits over time. Now that your child has a savings account, a checking account, and a working budget, they have a strong financial foundation. The next building block is understanding credit. Credit can be a powerful financial tool when used responsibly, but it can also lead to serious problems when mismanaged. Like all of the other topics that we've covered, you want to tailor this conversation to your child's maturity and age. For younger children, you can introduce the basic concept through lending scenarios at home. For teenagers approaching adulthood, you'll want to have more detailed conversations about credit scores and credit cards and responsible borrowing. The goal is to demystify credit so it's not something they stumble into unprepared, because that could really create a lot of damage and be difficult to recover from. I'll just pause here for any questions.
There are no questions at this time.
Perfect, thank you. So this, for younger kids, we have a quick little example. A lot of kids struggle with waiting. They want things and they want them now. The need for instantaneous gratification will sometimes rear its ugly head. This is a good time to create a learning opportunity specifically for younger children. So let's say your child wants a Lego set, but it's $60 and they don't have that in their budget or their savings account. So you let them know that you will give them some credit and loan them the money to make the purchase. However, they need to pay you back each week from their allowance, but it needs to be paid off in 8 weeks. So have them do the math and determine that they need to have $7.50 a week to pay it back in 8 weeks, but they only earn $5 a week. So this is giving them the choice to see that sometimes you have to really be careful with your budget and you don't always get everything you want. Or you can give them the choice to do extra chores to earn that extra money, or make them wait until they've saved enough to make that purchase. Ensure they understand that if they don't make their loan payment each week, the toy will be repossessed. So it's a life lesson that will only work if you follow through, and it's hard sometimes because you don't want to have to listen to the crying and whining, but follow through is really important. And then make them pay you back after they get that chore money and really repossess that toy if they don't earn the required amount. It's a good way to introduce the concept of credit with lower risk. As children edge toward adulthood, it is increasingly important to help them understand that credit impacts many aspects of your adult life. It's not just about credit cards. It comes into play anytime you apply for a loan to buy a car or a home, sign a lease to rent an apartment, and then in some cases it shows up when you were applying for a job. Some landlords and employers run credit checks as part of their screening process. So if you help your teenager understand this as they're younger, you're preparing them for the reality that their financial reputation follows them, and then that building good credit early gives them a significant advantage. Start the conversation by explaining what a credit bureau is. Tell your child to think of a credit bureau as a company that keeps track of how we handle our money. So in other words, your credit report is basically a financial report card. It shows that you've managed your money over time, whether you paid your bills on time, and then you kept up with what you owe. Better your track record, the more people trust you with things like loans and leases. So the better your track record, just like in school, the better your grades are. And if your child wants to know more, you can explain that there are 3 main credit bureaus, which are Experian, Equifax, and TransUnion. And a fun thing that you could do together, if you're comfortable with it, is to pull up your own credit report at annualcreditreport.com and walk through it with them. It's a great way to make it real, using real data, and show them what a credit report actually looks like. If you are using Savvy Money through Main Family's online banking or mobile app, you can do the same thing. You can actually see your score and then your credit history below that. So it's a good way to demonstrate your own credit history and responsibility. So the credit bureaus take that information that's been reported to them by creditors, landlords, or other people you owe money to, and they use that to determine your risk level, which indicates whether you're likely to pay back future credit. And it's done with the credit score, which we just explained, which is a 3-digit number that helps companies assess your creditworthiness alongside with your income and assets. It's not just your credit score that is what makes the determination. There are other factors that come into play, such as your debt to income ratio and other things like that. So once you feel like your teenager is ready to take on some responsibility with credit, consider adding them onto your credit card as an authorized user. Be sure that you work with them and explain how they should be using credit and who is responsible for the charges. Maybe start with having them make purchases on the credit card to buy gas for their car. And then it's their responsibility to pay that back by the end of the month. It's a good way for you to monitor their usage and help avoid starting bad behaviors with credit cards. So after proving they've responsibly used the card and they're 18 or older, it's time to move from being an authorized user to either becoming a joint owner on an account with you or applying for a secured credit card. A secured credit card is a type of card that requires a cash deposit up front, which serves as the collateral and is basically your credit limit. So for example, if you deposit $500 on a secured card, that is the credit limit, $500. So a secured credit card works like a regular credit card where you make purchases up to $500, you receive monthly statements, and then you make payments. The secured credit cards help you build credit history with on-time payments and responsible use. The $500 is not used to pay the money back. You still have to make payments. But if you use the card responsibly for 6 to 12 months, issuers will often refund that initial deposit and then upgrade it to an unsecured credit card as you demonstrated responsible use. So the big picture is really making sure that kids get what it means to use credit responsibly. Walking them through the basics that every credit card comes with a spending limit, which is the most you can charge to it. It has a due date for payments. Ideally, you want to pay off the full balance every month so you're not paying interest. Sometimes it's not possible, so they need to make sure they're making at least the minimum payment on time, because missing a payment or not making a minimum payment excuse me, can lead to derogatory marks in your credit report. So every credit account has a cap on how much you can spend. And a good rule of thumb is to try to keep your balance under 30% of that limit. And that's what helps keep your credit score in a good place. And it's actually a significant portion of your credit score. And encourage them to not just open new accounts because a store offers you a discount or something for free. Those types of things can actually hurt your credit, and a lot of times their interest rate is extraordinarily high. And then the more accounts they have, the harder it is to stay on top of everything. So between doing that, making sure that they're not spending too much of the balance, making sure they're making regular payments, and then also making it a habit to check your accounts and your credit report regularly so you can catch any mistakes or signs of fraud early. So I hope that everyone is feeling more ready and confident to start these important money conversations with your children. The topics we've covered today, from opportunity cost to credit, provide a solid framework for raising financially healthy adults. As we close out today's workshop, let's just review some practical tips that will help you succeed in this ongoing journey. Remember, teaching kids about money isn't a one-time conversation. It's an ongoing dialogue that evolves and as your child grows and faces new financial situations. As we mentioned throughout the workshop, leading by example is really the most powerful teaching tool you have. Children learn far more from watching what you do than they do from listening to what you have to say. So share your own budget with them, talk openly about the financial choices you faced, and be honest about the hurdles you've overcome. If you've made financial mistakes in the past, don't be afraid to share those lessons too. If you show vulnerability and growth, it models the behavior that you want them to develop, the ability to learn from mistakes and keep improving. Talk freely and openly with your children about money in age-appropriate ways. Many families treat money as a taboo subject, but research shows that children who grow up in households where money is discussed openly tend to make better financial decisions as adults. The key is to keep the tone positive and educational rather than stressful. Let them know that sometimes you'll need to say no to a spending wish and that financial plans sometimes need adjustments. Frame these moments as normal part of managing money rather than sources of anxiety. When children see that financial challenges are manageable, They develop resilience and confidence in their own ability to handle money. Positive reinforcements go a long way in building lasting financial habits. When your child asks you questions about money, let them know you appreciate their curiosity and take the time to give thoughtful answers. When they reach a milestone, whether it's their first $100 saved or sticking to their budget for a full month or resisting an impulse purchase, celebrate that achievement. Celebration doesn't have to be expensive or a big deal, but just acknowledgement and praise are often enough. This positive association with good financial behavior makes them more likely to continue making smart choices on their own. We know that managing money can sometimes feel stressful and overwhelming, both for you and your child. However, consistency is key. Just like playing a sport or learning an instrument, the more you practice good financial habits, the easier and more natural they become. So encourage your child to stick with their budget even when it feels challenging. Remind them that every successful person has had to practice discipline with their finances. Over time, what once felt like a chore will just become second nature, and they'll start to see the real benefits of their efforts in growing their savings and their financial confidence. Finally, and perhaps most importantly, resist the urge to fix every financial mistake your child makes. It's natural as a parent to want to protect them, or a guardian is to want to protect them, but some of the most valuable lessons come from experiencing the consequences of poor financial decisions firsthand. Child who blows their entire allowance in one day and has nothing left for the rest of the week or the rest of the month is a lesson that no lecture can teach. So these small, lower stakes mistakes that they make now will help them avoid much more costly errors in the future, like accumulating credit card debt, failing to save for the emergencies, or not making payments on credit that they owe. Trust the process, stay supportive, and let experience be the teacher. It's hard. It's hard to see kids fail, but this is one of those places where they really need to learn from their mistakes. If you want to take a closer look at your own specific financial situation before you start teaching your kids, we welcome and encourage you to call our partners at GreenPath Financial Wellness. GreenPath is a nonprofit organization that we partner with to provide resources to help you lead a financially healthy life. They will go over your budget with you and help you create a balanced budget. They can help you if you have debt that you need to repay. They can work with you to make sure that that gets paid back in a timely manner and help you maybe save some interest. So we really encourage people to contact GreenPath, even if it's just for education or questions. They're there to help you. So you can visit our website, mainfamilyfcu.com/GreenPath, for the contact information. So that's all I have for today. I really appreciate everybody's participation and attendance. This is a really important topic because kids are not learning enough about money in school. So we as families need to make sure that we're providing them with the resources they need to make important and good financial decisions. We will follow up after this webinar with an email that has a link to the recording and then some different resources that you can use to help teach these lessons. We host these webinars monthly. So definitely check out our financial workshops page to stay up to date on future sessions. I will stop now just in case there are any other questions.
We didn't have any additional questions, but we did have something in the chat saying that it was a great presentation, and thank you, Rachel.
Well, thank you. I appreciate that. And thank you very much for your time. And I hope to see you again at a future session.